So one stock listed on NYSE is down around 20% just since last December, presenting a great opportunity to buy the dip. Company fundamentals are sound and I am personally heavily buying it after this fall. I expect to achieve returns of at least 15 to 20% in a year if everything goes right. And the good part is the risk is not that high either. So the company I am referring to is HDFC Bank Limited. It's the world's 8th largest bank by market capitalization, even after falling by 20% in a month. Its ticker symbol is HDB, currently trading at around $54 US. HDFC Bank Limited is an Indian multinational banking and financial services company. It is India's largest private sector bank by asset. I am not just here to share the stock name. I want you to understand what makes it a great opportunity so you can find a similar opportunities yourself. So please don't skip. So what I typically focus on is understanding the reasons behind a stock's sell-off and assessing whether the company can address those issues in the future, especially considering its track record. Regarding the sell-off after releasing its third quarterly results of 2024, there are mainly two reasons which I found. One reason was the moderate deposit growth of about only 1.9%, and the second reason was flat net interest margins at 3.4%. Now, just in case if you don't know what net interest margin is, then when you deposit your money in bank's checking or savings account, bank lends that money to borrowers as loans at higher interest rates compared to what they pay you in your checking or savings account. So that difference between the interest earned from the loans and the interest paid out to you is called the net interest income, and that net interest income divided by the average interest earning assets gives the net interest margin. So net interest margin higher the better. Now the exciting part is that the current price has already factored in these points, presenting a great opportunity to get in at this level. The company possesses great capabilities to overcome the challenges of lower net interest margins and slower deposit growth. But how? Well, interest rate cuts are anticipated in India in 2024, which will lead to lower cost deposits in their checking or savings account, consequently improving the net interest margin. Additionally, the deposit growth can be enhanced by expanding its branches across India. The bank's target is to open 500 to 550 branches by the end of 2024. In terms of stock valuations, it's currently trading at close to the lowest price to book ratio in the last decade. As seen from this graph, its average price to book ratio is 3.2, while the current price to book ratio is around 2.5. And if we compare this current price to book ratio to its lowest price to book ratio of 2.3 during the COVID crash, then it's very attractive at this point. So getting in at these levels, you can be assured that the downside risk is very minimal when holding it for the long term. In short, I would never miss this opportunity to buy the great companies at discounted prices, even if the short-term outlook might not be clear. And it's very well known that the company has a proven track record of getting out of these situations, and the management is very strong. So thank you for watching this video. If you like my content, please do like, share and subscribe the channel. If you have any questions, feel free to ask me in the comment section. This video is just for an educational purposes, and please do not consider it as any recommendation to buy or sell the stock.